Today is the last stage of our 4-stage plan, during which we will be focusing on how returns can be measured. Remember that from the shareholder viewpoint, the return on his investment represents a key factor affecting directly his investment decision. Here we are only dealing with financial issues rather than social or political problems, which are also of critical importance in this kind of public investment. The shareholder's point of view, you have the amount of equity, the past return on his investment, it's called the return on equity, and the return for the next years. From a financial point of view, the company uses shareholders' equity and bank or financial debt to finance its fixed assets and working capital. This phenomenon is referred to as the capital invested, while shareholders' equity consists of share capitals plus return earnings. Broadly speaking, the return on shareholders' investment is called return on equity. How to measure the return on equity? You divide net income by shareholders' equity. Return on equity measures the rate of return on the ownership interest, the stakeholders' equity, of the common stockholders. A rising return on equity suggests that the company is increasing its ability to generate a profit without needing as much capital, while simultaneously indicating how well a company's management is deploying the shareholders' capital. Some industries tend to have higher returns on equity than others. As a result of this, comparisons of return on equity are generally most meaningful among the same industry. And the definition of a high or low ratio should be dependent on the context. For example, the return on equity in the water supply industry in the USA was about 9.4% in 2018. We have seen previously that the company has various sources of financing which are not limited to shareholders' equity. This phenomenon is referred to as the capital employed, and from which it is possible to compute the return on capital employed. The return on capital employed measures the profitability of capital, which is calculated by dividing operating profit, it's called NOPAT, if the return on capital employed is to be measured on an after-tax basis, divided by capital employed. The first ratio, operating profit after tax, corresponds to the operating margin generated by the company, while the second, sales divided by capital employed, reflects asset turnover, which indicates the amount of capital employed required to generate a given level of sales. The return on capital employed is often regarded as the single most important measure of companies' profitability. In the UK, the average return on capital employed for the water and sewerage companies was 6.5% in 2005-2006, and it was 8.4% for the water-only companies. What constitutes a reasonable return on capital employed is a matter of lively debate. For instance, if a company's return on capital employed shows a sustained decline over a period of years, it could mean that a company attempts to slash its costs with potentially adverse effects on its services or quality of service. On the other hand, if a company is showing high and steadily rising return on capital employed rates, especially above the industry average, it will be reasonable to question whether the consumers are paying more than what they should need. What is the relation between return on equity and return on capital employed? Return on equity measures the rate of return on the ownership interest, it's the shareholder's equity, of the common stock owners and highlights the relationship between return on capital employed and return on equity. In addition, the return on equity formula can be disassembled in two parts: return on equity on capital employed and leverage. So net income divided by shareholders' equity is equal to net income divided by capital employed times capital employed divided by shareholders' equity. What is the leverage effect? For instance, when a company raises debt and invests the funds it has borrowed in its financial and commercial activities, it generates operating profit that normally exceeds the interest expense due on its borrowings. The company generates a surplus consisting of the difference between the return on capital employed and the cost of debt due on its borrowings. This surplus is attributable to shareholders and is added to the shareholders' equity. Let's start the case study with a concrete example, the Water Utilities Corporation of Botswana. And we start by computing the return on equity. The most basic formula to calculate return on equity consists of inserting net income for a company as the numerator, and the denominator for return on equity is equity. In addition, the net income can be found in the P&L or statement of comprehensive income. The denominator for return on equity is equity and can be read in the balance sheet. As displayed on this screen, the return on equity for 2016 is 2.1%. Computing the return on capital employed. The return on capital employed is calculated by dividing operating profit after tax by capital employed. EBIT can be found in the statement of comprehensive income in the P&L. And here the tax rate is 0%. So EBIT after tax divided by capital employed. Working capital plus fixed assets is named capital employed. We have already explained how to compute working capital and fixed assets in a previous video. The return on capital employed for 2016 accounts for 2.4%. So the 2016 ratios indicate positive profitability and efficiency levels. However, we need to go beyond the figures. The rates of return were found to be negative the year before due to a poor EBIT. Without the revenue grant from the government in 2016, the company has not been able to increase its operating profitability with a stable level of capital employed. So that's the conclusion of our financial analysis. In closing, this is a quick reminder of the basics of financial analysis. If you remember our toolbox, you can now use those tools in a real-world context. Remember our plan, wealth creation, which can be assessed through sales, EBITDA, margin, working capital, operating cash flows, requires investments, assessed with CapEx, nature and quality of investments. That must be financed. It's equity to debt mix, allocation of free cash flows, liquidity, solvability, and which will be sufficiently profitable, is the return on equity and return on capital employed. Thank you very much for your attention.